Welcome to the deep dive. Great to have you with us. Today, we're really aiming to cut through the noise on a pretty critical global shift. Our mission, we're taking a close look at the International Monetary Funds, the IMF's latest global economic forecasts, and specifically, we want to unpack the, well, surprising shifts being driven by today's trade dynamics. Think of this as your shortcut to the bigger picture. And the headline coming out of our sources is quite stark, isn't it? The IMF has significantly revised its global growth forecast for 2025 down to 2.8%. That's a big cut. It means less growth, fewer jobs potentially. What's really behind such a substantial shift?
Yeah, it's a significant revision. And what's fascinating, or perhaps worrying, is that the primary driver seems to be this recent surge in protectionist trade policies.
Yeah.
Basically, countries trying to shield their own industries, making imports harder or more expensive. You look at the United States, for instance, implementing tariffs. Those are taxes on imports at levels, well, not seen in a century, apparently. And actions like these, they really ripple outwards. They disrupt global supply chains, obviously. They push up costs for businesses and ultimately for consumers, too. And crucially, they just inject a whole lot of uncertainty into the economic outlook.
Right, uncertainty. And it's easy to talk global impact, but how does this actually filter down? How does it hit the major economies individually? Is it sort of a uniform thing, or are we seeing different stories?
Oh, it's definitely varied. Very different stories. For the U.S., the forecast for 2025 growth is now cut to 1.8%. That's quite a drop from the 2.8% estimated for 2024.
A full percentage point. Wow.
Exactly. Then you look at the Eurozone, projected at a much more sluggish 0.8% growth overall. Within that, you have countries like Germany really facing stagnation, kind of treading water. Though, interestingly, Spain is mentioned as a bit of a positive outlier there.
Okay, Spain doing a bit better, and China.
China's growth has also been revised down to 4.0%. They're dealing with weak household consumption, spending isn't strong. And again, these adverse trade policy developments are hitting them too.
So it really sounds like these trade policies are creating winners and losers, or at least different levels of impact. The IMF also projects something else interesting. Global trade growth slowing even more than output growth, down to just 1.7% in 2025. What does that specific signal tell us when trade grows slower than the economy itself?
That's a really key indicator. It signals a significant slowdown, yeah. It suggests that international trade is facing serious headwinds. Think about businesses having to reroute their supply chains, dealing with higher tariffs, navigating all this policy uncertainty. It just makes doing business across borders much more complex, slower, and definitely less efficient than it used to be. It's like throwing grit in the gears of global commerce.
Grit in the gears. I like that. So trade slowing, what about prices? Inflation. The IMF seems concerned that it's going to stick around longer than hoped. Why is it proving so stubborn?
Well, there are several things feeding into that persistence. First, those tariffs we mentioned, they directly increase the cost of imported goods, right? That feeds straight into prices. Then you still got some lingering effects from the pandemic disruptions, plus energy shocks from geopolitical events. And there are also potentially deeper structural things at play, like aging populations in some countries, maybe the costs associated with climate change adaptation. It's a mix of factors.
So a complex mix keeping inflation sticky. Given all these challenges, the trade friction, the inflation, what is the IMF actually recommending? What policy levers can be pulled here?
Well, internationally, the big push is for cooperation, trying to get back to a more stable, predictable trade environment. That's obviously easier said than done right now.
You can say that again?
Domestically, though, they're focusing on countries needing to tackle their own structural imbalances. Things like promoting healthy aging so people can work longer if they choose, boosting labor force participation, especially for older workers and women, and, of course, smart investments in infrastructure, basically fixing the foundations at home.
Are there any places that seem to be, navigating these choppy waters a bit better? Any positive examples?
Yes, definitely. Some emerging markets are showing more resilience. India, for instance, is still projected to have pretty strong growth, around 6.5%. That seems linked to big investments they're making in infrastructure and also their digital expansion.
Okay, India's a bright spot. Anywhere else?
Southeast Asia as a region also seems to be benefiting somewhat, perhaps from some of that trade reorientation we talked about. Companies looking for alternative manufacturing bases, maybe shifting supply chains regionally. So yes, some relative bright spots exist.
Good to hear it's not all doom and gloom. But let's talk risks. If these trade tensions keep ratcheting up, what's the potential downside? What's the scenario we really need to avoid?
The downside scenario is quite concerning. Continued escalation could further dampen economic activity across the board. It could lead to increased volatility in the financial markets, stock markets getting jumpier currency swings, and potentially tighter financial conditions, meaning it gets harder and more expensive for businesses and even governments to borrow money.
And the IMF put some numbers on that risk.
They did. They warned that ongoing trade fragmentation could really hit investment and lower productivity growth. And it could lead to inflation being even more persistent than currently expected. They estimate there's about a 30% chance and a nearly 1 in 3 chance that global growth could actually fall below 2.0% in 2025, and inflation could simultaneously spike above 5.0%. That's a stagflationary type of risk.
Below 2% growth, above 5% inflation. That sounds quite painful globally.
It would be, yes.
So what are the concrete steps then to try and steer away from that outcome, to restore some predictability?
Well, the ideal path involves restoring that predictability to the trading system. That means, ideally, rolling back some of these recent protectionist measures. It means getting countries back to the table for constructive trade negotiations and strengthening the multilateral agreements, the rules of the road for global trade that we used to rely on more. Alongside that, countries really do need to keep working on those domestic structural issues we mentioned, building resilience from within.
A combination of international cooperation and domestic homework, essentially.
That's a good way to put it, yes.
Well, thank you. This has been incredibly insightful, really helping to unpack what's behind those headline numbers. It's complex, but definitely crucial to understand. And for you listening, as you go about your day, maybe take a moment to think about this. Beyond the big global trends, what specific shifts are happening in your local economy? Are there things making it more vulnerable to these trade tensions and inflation pressures? Or perhaps things that are actually providing some protection? What do you see happening right around you? Something to ponder. Thanks again for tuning in to the deep dive. We look forward to having you join us for our next exploration.